Hey friends, it's been a while. Welcome to the Real Deal podcast with Suzanne and Sarah. I'm Sarah.
I'm Suzanne, and we're so glad you're here, and we're glad to be back because it has been a while. If you don't remember who we are investor-minded real estate agents in Central Oregon, although you might be able to tell from my background, I'm not there. Sometimes we're in different places. So we are here to talk about what is actually happening in the real estate market and what we are seeing in real deals and how thoughtful investors are making smart long-term decisions.
So if you're here for gritty strategy and real conversations without the hype, you are in the right place, hanging out with us.
So we are going to be talking about something that is nicknamed infinite banking in the financial world, but it has lots of different names. That's probably the name you've heard of it by. We'll explain what it is, what it is not, and when it makes sense for you as an investor to consider it as part of your overall financial strategy.
This topic, you might have heard of it with other names, and it can come with a lot of noise online. So our goal today is not to sell it to you, but to help clarify it for you. And recently in our last meetup, we brought in Teresa because she has been doing this for over 25 years, not because it's trendy, but because she actually has seen it work for investors in real life and cares about the outcome for everyone. And she's the best person to hear it from directly. And you'll be seeing some clips from her and hearing some of her really amazing quotes throughout this episode. So yeah, we're going to cover what it is, who it's good for, and who it's not good for, and how real investors like you or aspiring investors like you in the room are using it.
Okay, so you might be wondering, this is a real estate adjacent topic, but it is definitely a financial topic and something that certainly plays into real estate. And that is why we hosted an event all about infinite banking. So, as investors, our general goal is to have our money working for us, right? That's the general goal of an investor, is like put your money somewhere that it can be making babies. And this is a great way for investors to do that. And the sort of magical part of infinite banking and what truly does make it infinite is the fact that your money can be sitting in two places at once and earning in both places, which it's kind of conceptual. But what I want to give you an example of, like, there was someone, Larry, who joined us. He was a guest speaker of our guest speaker, and he researched this topic for 2 years before he invested in a whole life insurance policy, which is what infinite banking is. The foundation of infinite banking is those whole life policies. So he's an engineer or something like it, and researched for 2 years because he was just like, dude, this is too good to be true. Like, there's no way your money can be, like in two places at once and earning money in both places at once, right? So, but the idea is your money, you invest it into a whole life policy, and then you can borrow against it and use it for private money loans, use it for a down payment, or to fund a full purchase of your next real estate investment. You can do it for rehab funds. You can do it to buy your next car. You can borrow the money from your policy to do all these other things. Ideally, you're using it to make more money, right? Another investment like a private money loan. But the cool thing is that even though you took it out of this little bucket over here of your life insurance policy is still accruing dividends as if the money was still there, even though it's over here working for you in a private money loan, in a flip, in a rehab, and something else that you're doing. That's truly the magic of this. So we love things that are kind of doing double duty essentially. And, that's also the thing that makes real estate investing so amazing is, it's one of the few things where you borrow someone else's money, sometimes your own, to purchase and then pay off that money with someone else's money, like a tenant or an end buyer. That is the background of why we hosted this. And it's pretty amazing for a lot of us in the real estate space because a lot of us are buying real estate with these policies, or we're loaning money, or we're building other side businesses. It's just basically helping us scale more quickly and putting our money to work for us more quickly, with the whole goal at the end of being able to live the lifestyle that we want to live. And that's usually done by having income that is truly passive, which does not require the exchange of our time for that money.
Yeah, and kind of the funny thing, and one of the stories that was told in our meetup event is Suzanne was one of the biggest skeptics of this. She had a good friend telling her that this was a scam. And, something that's important to us and in all of the work that we do is, if something seems too good to be true, our instinct is to think it's too good to be true, right? So that's when we actually take the time to slow down and understand it. And that's one of the big reasons we wanted to have Teresa come in to explain it to us, not sell it, but explain it. So really, what we learned through this meetup is that it's a strategy and it's not at its core a product, really. Infinite banking is really banking on yourself. And the most important part, yes, part of it is a product, and the product is actually the asset that you're borrowing against. And that's what properly designed whole life insurance, right? So I was sold whole life insurance more as a product than a strategy when I first signed up years ago for it. And, I'm really only now understanding, the core concept of it as a strategy and the use of it as an investor, and really diving into the design of my policy and dissecting how we can how I can leverage it in my own real estate goals. And, that's part of what we're here to help you think about for yourself today as well. So really, you can think of it like your own private line of credit once you've funded your account to the point where there's enough in there for you to borrow against, right? And we talked about, you're borrowing money from your own account, and your account continues to accrue interest as if that money is still there. But that can happen because it's backed by the asset of your whole life insurance policy. So if you go away, default on it, the life insurance company has something to recoup their losses against, right? So that's why it continues to compound even when it's borrowed against. And in some markets, you are borrowing money, the rate at which you're borrowing your own money for, because sure, you're still being charged an interest rate for the money that you're borrowing from your account, will continue to accrue interest at a greater rate than what you were being charged to borrow your own money. So that's the crazy part of this. Does that happen all the time? No, in every year, but it is 100% possible.
Yeah, and that's the interesting part, and where some people may have an objection of well, I'm still paying interest on this money. Well, yeah, but who are you paying that interest to? Yourself. You are benefiting from the interest you're paying yourself, instead of that money going out to a bank or a third party or some other lender who then benefits from the interest. You actually benefit from the interest you pay into the policy. And one thing that was really powerful that Larry said on the meeting is you can set up your own repayment plan on terms that work for you and your situation. You can decide to pay back monthly or quarterly or annually or, any dollar value, because you are paying yourself back. The goal of paying yourself back is so that you can borrow the money again and use it elsewhere again, so it can be working for you again in both places. So the whole goal isn't just to let the money sit in the policy and do its thing. The way you get the most out of this policy that I'm learning, and I haven't done this yet, is to pull it out and start lending it or using it for your next purchase or whatever, and then paying it back in. So that's what keeps this whole cycle going. And Teresa, the technical term for having your money working, even when it's not technically in your policy, is called uninterrupted compounding. And for all of us who have taken Personal Finance 101, compounding interest is the reason you can put, $5,000 a year into your Roth, and then by the time you retire, you have $1.6 million. Compounding is incredibly powerful. And to have money compounding that's not actually there, it's being used over here, is mind blowing.
So I think,
legit. I tell you from
yeah.
research, legit. So yeah.
Good. Yeah. I'm just going to say, so you and I have been spending a lot of time, I think, personally thinking about why this matters for us and how we can employ our own whole life insurance policies. The cool thing is we can set them up for our partners, for our children, and have access to many different accounts, and also be setting people up in our family for success for the future. But yeah, Suzanne, private money lending, obviously, I think could be a great use for yours. For myself, cash flow gaps, or just things like renovation funding, or even down payments for my next investment properties, given that, we all want to be buying at least, one property a year for, offsetting tax purposes. But Larry, who was in this meeting, did things he bought fancy cars. He invested in the Grant Cardone fund. He did pre-IPO investments. And does everything go perfectly? No, but would he have had the opportunity without this? Maybe not, And like Suzanne said, he paid himself back on his own schedule. So Yeah, I mean, it's not about avoiding interest. That's like we, as real estate investors, we're not afraid of borrowing money. It's about where that interest goes and where it flows. And this whole idea of it flowing back to your own account is a pretty unique opportunity. But who do we think this is not for, Suzanne?
Yeah. That's the interesting question too, is like these things are not one size fits all. It's not for everyone. And that's probably a good thing. And, Teresa really boiled it down by saying if you are not a saver, if you're living paycheck to paycheck, if you don't have reserves, if you're really just like, I want the next like fast, quick buck, and if you're uncomfortable with like these long-term strategies that feel like, like you're saving for retirement or whatever, which you kind of are, or you're saving for like, a long-term liquidity event that you likely will not enjoy, but your beneficiaries will, then it's probably not for you. If you just like can't manage money in that long-term way yet, then wait. There was a great question during the event where someone said, well, what if I can't pay my policy every year? And Teresa's answer was pretty clear. And it was like, if you can't commit to this every year for at least 4 years, ideally 7, then this is not for you yet until you can commit to that. And the amounts we're talking about are not massive either. And, it's up to you and your financial situation and your goals and what you're saving for and what you're trying to invest in. You can start with like $500 a month, $1,000 a month. What is that? That's $6,000 to $12,000 a year, where it starts to actually make more impact in your real estate investing or private money lending strategies is probably when you're investing like $2,000 a month and then you've got $24,000 going in a year. That's when you think about what down payments cost or what rehabs cost, like that's about the level you need to be at to really have it start working for you in a meaningful way.
So, I mean, that being said, it is for investors who are sitting around with a little bit of surplus cash, who are looking for, an alternative interest accruing asset, right? People, who are lending money on their own, they're private money lenders. And what I want to just touch on one more time is just, there's different ways to fund these things as well, right? Like Suzanne was saying, $600,000, $2,000 a month on a regular basis, but there are also ways to fund these accounts a little bit faster. I think you have to be strategic about it, but again, in any given tax year, I think there are strategies for funding your year all at once, or doing it at a slower cadence. Myself, for example, I do it on a monthly basis and just do it consistently. But yeah, this is a long game. The one consistent thing in investing in general, whether it's real estate investing or otherwise, is like time is our greatest asset in returns. And this is not an exception. So yeah, one great line from Teresa to paraphrase is serve the policy on the front end so it can serve you on the back end, right? So
And that doesn't just mean the death benefit either. One thing that you'll hear if you listen to the full replay is she said, after a certain point, your policy can feed itself. And I think someone in the meeting was just like, afterward was like, what did she mean by that? And what that means is that you really only have to pay the policy premium for as long as you want, depending on the strategy you're trying to employ. Like you're not signing up for a lifetime of monthly or annual policy payments. What happens is once it starts getting the flywheel going, you're borrowing and putting it back, borrowing, putting back, paying yourself interest, and it's just like, earning dividends and doing its thing, then it actually generates enough dividends to pay the policy premium every year. That's what she meant by it feeding itself. So after 4, 7, 10 years, I mean, she does all these really amazing customized scenarios based on your age and your health and your goals. You can have a policy that is self-funding. I don't know exactly, but like maybe even as few as like 7 years. So yeah, I just want to be clear that you're not like signing up for a lifetime of paying into this thing before it actually helps you. And that was one big thing that she talked about at the end was like, a lot of people are just like, well, I don't need the death benefit. It's not going to help me. Right. And so this was a big insight that I think a lot of people miss. So, Sarah, you want to take this one and talk about it a little
yeah,
bit?
I mean, that's the sleeper insight, right? I mean, this is the part that is silent, but can have a huge impact. I mean, yeah, this one-time liquidity event, like she talked about, like, okay, so you personally fund yourself, but really the right order of operations is to make sure the people above you, meaning like your parents and grandparents, have policies as well, because when they die, that therefore is creating a major liquidity event for yourself, and it solves things like estate timing issues. It helps you leverage risk. I mean, it helps you buy out, partners. And yeah, I mean, if you have your death benefits assigned correctly, it's deal security, and it's a very advanced move that none of us should ignore. So, yeah, I mean, it tends to take like the back seat in this conversation, but it's a real and meaningful benefit as part of this that, I mean, even before I had whole life insurance, I started with term life insurance before I knew better, right? And now I have both. But just, if you're thinking ahead just for your own sake, like this is should be the first reason to start. And then the rest is just icing on the cake, really. So
Just
yeah,
the
yeah.
estate timing issue, like that's general. And what example of that is, let's say a parent or grandparent dies and their house is owned outright, and the beneficiaries, or the heirs, get it at that stepped up basis, meaning it's worth, let's say, $1 million when they die. So their heirs get it at that value, right? So then if they ever sell it, that's their basis. So they're not paying a ton of taxes on the profit versus what grandma paid for the house. However, what you see and what we see a lot in real estate is like heirs sell homes for a couple of reasons. One is like maybe they can't afford to pay the property taxes. Like on some of these houses that are, $1 million, like that may be like a $10,000 a year property tax bill, or they just don't want the hassle, right? But if they had the death benefit to pay for those things, then maybe they could afford to be like an investor, a really lucky person that inherits $1 million paid off asset because they can afford the $10,000 a year property taxes or whatever it might be. So that's what I wanted to just explain too, because a lot of times people sell because they can't afford to keep properties, or maybe the property is not paid off and they can't afford to pay the mortgage. Well, if they got a death benefit payout of $2 million and there was an $800,000 loan on this house, and really they did want to keep grandma's house, then they could pay for it and own it outright, or at least make the monthly payments with that windfall of the death benefit.
Yeah, having choice is what this provides, right? Not being forced to do one thing just because there's a death in the family. So, anyways, I mean, this whole episode isn't about convincing anyone about anything. It's really just our goal with these episodes and with our education is to give you more tools and more choices. There's so many different ways to invest in real estate, and the tools that we get to use are creative, and we love the creative tools. So more than anything, we hope this sparked curiosity for you and yeah, helped you understand this tool a little bit clearer and just gave you some things to think about.
Yeah, and also for you to see some different examples of how something like this, like life insurance, what real estate investors are talking about life insurance. Well, it is a tool to help you in your real estate investing journey as a flipper, a rehabber, a buy and hold investor, a lease option investor, a private money lender, so all of us with these different identities in real estate investing can leverage this as a tool to keep our money working for us and making more money for us so that we can ultimately live the lifestyle that we're doing all this for anyways. So that's it for today. If you are intrigued by this whole idea, then you should absolutely watch the full meetup replay. We have the link in our show notes so you can check that out. And we would love to hear any questions that you have or introduce you to either of the guest speakers so that you can learn more and decide if this is the right thing for you. And as Sarah said, we're not here to sell this. We're not making money on this. We're just trying to educate ourselves and our fellow investor community on other ways to keep things rolling and get closer to our ideal lifestyle. So thank you so much for joining us today on the Real Deal podcast with Suzanne and Sarah. And we will be right back here in a couple weeks with more great info and more to share with you. Have a great one.
See you on the next one.